There's been a lot of chatter about whether the stock market needs more liquidity to go up, and if it doesn't get it, it's going to go down. I thought we would step back and look at what actually that means. What do the terms mean? And let's form an opinion. So the monetary base, that's where it all starts. It is the base from which other forms of money are created. Think of it as being the money of the central bank. And because of the relationship between the amount of money available to the system and the health of the economy, changes in the monetary base tend to be a leading indicator for the economy. Where's it going to go? Now, the money actually in the economy, the real economy, uses terms like M1, M2, and M3. And each one represents a total different measurement of the money, whether it's M1, M2, or M3. M2 quantifies the amount of money actually in circulation. So it is arguably the best money aggregate to assess the state of the economy, and it happens to be very highly correlated to the stock market. Now, often on Money Sense, you hear about what I said up front, and that is the market needs more money from the banks, the Bernankes of the world, the Draghis in Europe of the world to go higher. They, if the punch bowl doesn't get fed, folks aren't going to buy stocks. Well, let's just have a look at the way the real world works. So what's been going on with the money supply in the United States? Well, over the last 10 years, which is what this picture is, you'll see that for years, it really went nowhere. It grew with the economy, but not materially so. Then, of course, the financial crisis came. It skyrocketed up. It sat there through 9 and 10, and then it skyrocketed up again in 2011. And, of course, you can see since then it has pretty much traded sideways. But since last summer, not only has it traded sideways, it's now started to go down. This is the last year, and you can see that after climbing in the first half of 2011 and flatlining, it has now started to go down. And with that starting to go down, we see a decline in the rate of change. And that's what is shown on the bottom of this graph here, the 52-week rate of change in the monetary base. And you can see since the end of last year, the monetary base has been falling. Now, I said that the monetary base is a leading indicator for where the economy may be going. What about the real economy? Let's look at what has been going on with M2 and the stock market. Now, in this picture here, the stock market is the red line and M2 is the blue line. You can see that they're very highly correlated. You can also see that on the right-hand side, the blue line appears to be rolling over. Is the red line next? The red line's the stock market. Diana, what do you think?
That's incredible charting going on there. What we're also, and we say that as well, Andrew. The other thing that we're looking at is also the velocity of money. And the velocity of money is not showing that it's going that fast. And so the monetary base, so you look at Europe and they've done the LTRO. All that money has not made it into the economy, actually. It's sitting at the ECB, so it's not circulating. So we need to see that money circulating. Certainly this market is very addicted to liquidity, as we've seen in the last 2 weeks ago when Bernanke was speaking, and he said that QE may not be on the table. That's when the market started selling off. So we definitely do need to watch that M2 number, but we also need to watch for the velocity of money, and that will show us if there is inflation. What this also shows us, though, is that they can keep rates low, and that is what is needed in order not to let this debt dynamic that's going on with all this QE explode. Definitely we need to eventually find a way to not do any more quantitative easing as the marginal utility of each QE becomes shorter and shorter time. So I agree, we need to watch that.
I think one of the reasons as well why we're not seeing more and more of this money flow into the system at the rate that we would like it to is in large part because of confidence. And there's been such a significant lack of confidence in the marketplace as it relates to the corporate company managements. And certainly that gets exacerbated from the political situation. We all know we're heading into a political election year, and that is going to continue to put a little bit of concern and lack of confidence at this point in the marketplace. And that's a big driver as well that we've got to take into consideration.
And there's also the Bush tax cuts. cuts that would be coming off 2013, and they haven't even started talking about it.
Absolutely.
And that would really tax the consumer in the forms of higher taxes.
Now let's take a look at stocks making waves today.
All right, here are a few stocks piquing interest today. First, let's take a look at SodaStream. We're revisiting this name. We only talked about it about 2.5 weeks ago or so. And the reason why I want to bring this up is because the stock traded higher in a down day. And I always think that that's important to take a look at. It closed up about 3% or so. It's really on, and you can see up 3.01%. The reason being is that William Blair, which is very well known for its quality research products, in other words, finding these really good growth companies and understanding what the potential is. And they are out once again today talking about this company and, in fact, giving 10 reasons to buy. Well, first, let's talk about what SodaStream is. It is a company that allows you to make carbonated soft drinks at home. And believe it or not, it's a huge market. It's $60 billion just in the United States alone, $220 billion worldwide. And just think about the potential to make carbonated soft drinks at home. So I think that there's a really interesting call here from William Blair. I know that Andrew disagrees with it. He thinks this is a fad. I think that it's something here to stay.
I just don't see the intellectual property, and as a result, given what they charge for the product, north of $100, I just don't see the sustainability in the longer term. Simple as that.
Well, and at the same time, though, didn't you buy one?
For
you
now,
did buy
yes.
one.
Yes. Touche, fair comment.
There's a consumer appeal to this product, and they all, the market penetration right now is 0.6%.
Fair
I
comment.
mean, if they make it a mid-single digit market penetration, it's $5 in earnings. All right, Diana, you're looking at one as well.
Yes, I've been looking at Home Depot, but I just want to say one thing to your point. The consumer seems to be broken into two segments. Either the very expensive luxury, affordable, or not, either you buy the specialty stuff, or people have gone to the dollar stores and to Home Depot. And Home Depot, the reason we like it, first of all, it's trading, we go by price action. The price action is looking very good in a market that's not doing too well. Close to peak EBIT margins, but not at peak sales. As they grow sales, we believe that they're going to actually go higher than their peak EBIT margins at a time when the housing market has not even started to recover. And we'll talk a little bit about that, because there is a survey that came out from Credit Suisse yesterday that's showing that the realtor survey is showing some signs of life in that area. So, their sales are $300 per square foot. They have had same-store sales, positive same-store sales growth, or good same-store sales growth in all 40 of the regional areas. They are an oligopoly. Arguably, one of the competitors is not really a competitor, so there's just two companies, which is Lowe's. They're growing sales. They have good margins. They execute very good. They have increased their service, better training, and great culture. So we think that will beat their quarters in May.
So you continue to own it?
We continue to own it.
All right.
I was looking at SNC today. How could you not look at SNC in the Canadian marketplace? Down $1.67 to about 38.25. The RCMP raided their offices in Montreal. The reason I wanted to mention it was because on their recent conference call with investors, they said that they had turned over all the relevant material to the RCMP. I guess the RCMP thought there was some more material that was relevant. Anyway, this is a stock that I have repeatedly said to investors, stay away at this point in time. It's a quality company. Yes, they're winning new business, but you just don't know what's behind that fridge. There might be another cockroach.
All right, and moving on, Diana, you're looking at Google.
I was looking at Google today because they reported last night and they traded up $6 after the close, and it looked like excellent. So they had a very healthy 24% growth driven by an impressive 39% growth in paid clicks. Top line was great, but it's down on a stock split. Now, you'd say stock split usually breaks a stock upward, but they're changing something in the voting, non-voting. So you had one stock that was voting. Now you're going to have one stock that's voting, one stock that's not voting. So basically, it's diluting the regular shareholder vis-a-vis the insider, which has Class B shares, which is 10 times the voting power of the old A's.
Now, I wanted to mention Orbit Aluminum today. The ticker is ORT on the Toronto Exchange. It was halted for almost 6 weeks, started trading again last week, and I wanted to mention it to you today because we are going to have a bull and bear discussion about this stock Monday on Market Sense, and I think it makes a heck of a lot of sense to watch that debate.
All right. The other one that we're looking at is Infosys. We've got to take a look at this stock because it was down 13% on the back of a weak fourth quarter and very disappointing fiscal 2013 guidance. So you've got to take a look at the stock and understand what to do with it. It does trade at about 15 times 2013 earnings, so not too much downside perhaps from here. And it is one of the largest IT consulting companies in the world. And the potential, as we talked about at the beginning of the show, in terms of more and more regulations, this company potentially plays nicely into that. So could be an interesting buy here on this level.
Yeah, but investors clearly have moved away from India in the broader marketplace when you're looking at emerging markets. And Infosys, unfortunately, is based in India. So I think that that's going to hurt the stock.
Okay, we'll keep our eyes on it. Up next, China grows at the slowest pace since the financial crisis. Time to panic? Maybe not. We're going to speak with Carl Weinberg of High Frequency Economics to get his take right after the break.